Bitcoin options markets continue to signal near-term upside risks to the BTC price, despite warnings from strategists that Wednesday's Fed meeting could trigger bloodbath in cryptocurrency markets. According to a chart on the block, the widely followed 25% delta skew of Bitcoin options expiring in 7 days remained at 4.44 on the 30th of January, not too far below recent multi-year highs hit earlier this month in the 9.0 area. The 25% delta skew of Bitcoin options expiring in 30, 60, 90 and 180 days were all between 0.5 and 2.0, indicating more of a neutral market bias, though all also remain close to multi-month highs. The 25% delta options skew is a popularly monitored proxy for the degree to which trading desks are over or undercharging for upside or downside protection via the put and call options they are selling to investors. Put options give an investor the right but not the obligation to sell an asset at a predetermined price, while a call option gives an investor the right but not the obligation to buy an asset at a predetermined price. A 25% delta options skew above zero suggests that desks are charging more for equivalent call options versus puts. This implies there is higher demand for calls versus puts, which can be interpreted as a bullish sign as investors are more eager to secure protection against, or bet on, a rise in prices. Elsewhere, the Bitcoin open interest put/call ratio on dominant crypto derivatives exchange Deribit on the 29th of January slumped to a new record low at 0.38. That means that investors favor owning call options, bets on the price rising, over put options, bets on the price dropping, by a record margin. The Fed is widely expected to raise interest by a further 25 basis points on Wednesday, taking the federal funds target range to 4.50 to 4.75%. A 25 basis points rate hike will thus come as no surprise and shouldn't move markets at all. What matters to markets is the outlook for interest rates. More specifically, how many more rate hikes will there be? And how long will interest rates be held at the restrictive terminal rate? Markets seem to be taking the view that, after Wednesday's hike, the Fed will only lift interest rates by 25 basis points one more time, in March, and will then start cutting interest rates in late 2023. That seems to be based on the bet that 1, U.S. inflation, price and wage pressures, will continue to slump back towards the Fed's 2.0% target and 2, the U.S. will enter a recession later this year, meaning the Fed will have the room and desire to start cutting interest rates to support the economy. But strategists are warning that markets are underestimating the Fed's resolve to raise interest rates and hold them at restrictive levels for longer. According to popular pseudonymous macro-focused Twitter account The Carter, the Goldman Sachs U.S. Financial Conditions Index, FCI, is now at its lowest level since September 2022.